Now, we were talking earlier with our guest host this morning, Brianne Gardner, about the current geopolitical uncertainty. And this morning, Brianne came to the table with a lot of great numbers on what history tells us about investing in times of turmoil. She's an investment advisor with Velocity Investment Partners at Raymond James. And I find these exercises immensely helpful because we can get very caught up in the moment, but the markets have plenty of years of numbers for us to chew on. What did you find?
Yeah, I mean, I think right now everyone is watching closely to see, is the U.S. going to get involved or not? The odds did actually reduce from 82% of the U.S. getting involved to now down to 40%. And I know that Trump came out and said he's going to make a decision within the next 2 weeks.
It's amazing that we can we've got real-time numbers that are which highlights how the market is trying to price in unknowns.
Yeah. Exactly. And I do think that is important to have that information and have those stats so you can properly, invest in where you think things are going to go. Because I do think if Trump and the U.S. do get involved, then things could escalate a little bit more. You might see some more heightened volatility within the markets, which would cause stock prices to move. For us, I think looking at initial shocks or geopolitical events like this, they are usually quick spikes of volatility, but then we see quick recoveries. So when we do see war breakouts, markets do typically pull back. On average, we see about a 14% pullback, but recover quite quickly up to those peaks again of about 40 in only 47 days. So, you can see here's an example of some of major disruptions that we've seen or geopolitical shocks that tend to be a little bit short-lived. And really, if you look 1 year later, that's the important thing there, that you can see that the markets have been positive, right? So it does pay for investors to stay invested, because this is looking at oil, which is definitely a sector that does get impacted by war. But even if we're looking at the event in 1990, the Gulf War, or 2001, 9/11, those are two major events that have happened. The S&P was down 16% in 1990, down 12% in 2001. And then 1 year later, the S&P 500 was up 29% in the Gulf War. And 1 year later in the 9/11 attacks, the markets were up 12%.
And look, there are all sorts of investors out there. There are people that when there's a lot going on, they feed off of the opportunity to be moving in and out. But I guess maybe arguably one of the takeaways there, if you're a long-term investor, is if you do some selling in times of uncertainty, you might miss that rebound rally. I mean, you could even make that argument with what happened after Liberation Day in April. Yeah,
exactly. And I would 100% agree. I do think, there's a difference between the old saying of timing the market. We are active managers, but doesn't mean that, we are day traders by any means. We will make tactical calls like certain sectors, right? Especially sector rotation during times of uncertainty. If you're looking at wartime, defense, energy, and industrials tend to outperform in the short term. So stocks like Lockheed Martin, great there. RTX Corp, missile defense, General Dynamics that does the manufacturing kind of subs, land, sea, and airborne. Those are three companies that would definitely benefit in the short term from this. But it doesn't mean those stocks are fundamentally going to continue to outperform in the long run. So you can make some short-term tactical trades. But again, it does pay to be invested, because we do tend to see the market recover in less than 50 days.
It's interesting with defense, too. We actually had a guest this week who looks at defense as a technology sector now, just because when we look at warfare around the world, you've got drone attacks, you've got a lot more
cyber.
Yeah, exactly. Okay, so with all that said, you talked earlier about diversification. Maybe for those who might be thinking of calling in this morning as well, like when you think about the right look to one's portfolio, if you're staying committed to the market, even in a time of uncertainty, what's been on your mind with sort of what makes up a nice portfolio on top of some of those stocks you were just talking about?
Yeah, I mean, I think, again, diversification is key. I do think depending on where we are in the business cycle, being overweight or underweight in certain sectors can be more beneficial. Not just looking at asset allocation, but sector allocation, and same thing with geographic allocation as well. So for us, I know you mentioned in the beginning, too, gold as a defensive hedge if we think U.S. dollar is going to continue to go weaker. A lot of people don't really have gold exposure in their portfolios. We have right now tactically overweight 4% of gold. So that would say, I would say a little bit heavier for most people. You usually see like anywhere to 0 to 2%, if that. And a lot of people think of gold as like a boring play that, you know, doesn't really do much, isn't there? But in times of uncertainty or geopolitical risks or weakening U.S. dollar, we do see upside for the metal there. So we have added and went overweight in that exposure. Same thing again, oil, we talked about that, which I know we'll get into, but that's a great, you know, sector to tactically short term be in for geopolitical uncertainty as well.